Hello, everybody. We're just waiting a minute while everyone joins us. Thank you all for joining.
Hi, Betsy.
Hello. I see lots of familiar faces in the crowd. So we have more people joining us. Hi, Stacy.
Hello. Good to see you.
Brian, nice to see you.
You too. That was me saying hello, by the way.
I know, I recognize your voice. And
Hey guys, how
Deb.
you doing?
There's David and Ron.
Hello.
Hey, Ron, how you doing?
Good. How are you doing?
Hello, everybody.
Hello, Deb.
Hey, Deb.
Thank you
Hi,
very much
everyone.
for joining.
Thank you to our new people. I think I was looking at the list. I think this topic has attracted some new people to NYPAY, so welcome. Hope you enjoy it. We have a really good session tonight. So let's just wait another few minutes.
Hello, Nabil. How are you doing?
I'm all right, Ron. How are you?
Doing swell, thank you.
Excellent, excellent. Hello, everyone.
Hi, Nabil. How you doing? Been a long time.
Hi, Stewart. Yes, it has. How are you?
Good.
I heard you were speaking. I couldn't miss it.
No comment.
All right, we're just waiting just a few more minutes till everybody comes in.
Sounds good.
Wow, this is great. Thank you all for joining. I'm really excited to hear about this. I think this is an exciting topic. What excited me about this is when I saw it advertised in the subway as an employee benefit. Or be an icon parking worker and get your money paid early. So I was like, I want to learn about that. Okay, Nikki, do we have everybody?
I think it's a good time to start. Yes.
Okay, so I'm Betsy Waters and I'm on the NYPAY Events Committee. Thank you very much all for joining. As I said, I helped to organize this event because I just said this was something really of interest to me because I saw it in the subways and I was like, what is this all about? It's got to be going on. So I did some investigation and I found out that this is another fun, cool thing that fintechs are doing and turning things upside down with fintechs. So we have an evening of 3 different fintechs talking to us about what they're doing and 2 phenomenal moderators and panels. So as you all know, with NYPAY, we're about education and networking, and we're going to do both of those tonight. So the way of our playlist tonight is that we're going to start. Leslie Parrish from Aite-Novarica is our moderator and has done a phenomenal job. And then Sarah Grotta from Mercator Advisory Group is going to do an intro. So Sarah's going to give us a little bit of a level setting as to what is earned wage access, so we all know what it's about. How big is the market, things like that, kind of a quick overview. And then we'll turn it over to Leslie and she's going to moderate the panel with our 3 panelists, as we all know. And we'll see how these fintechs are really taking another topic of payday loans and turning it on its side, which is kind of cool. So just a few housekeeping questions. Once we start, if everybody can mute their phones and their cameras so that all of the bandwidth goes to the speakers, that would be great. And then a little plug for our next event. February 17th, our committee is quite organized. We have our next event already. Our next event is on February 17th, and it's called the Fintech Imperative. And we have a really good panel. I'm looking at it right now. We've got people from Cross River and Quinnipiac and really good panel and Clinical and Upstart. So they've got a lot of fintechs talking about the Fintech Imperative on the next event. The other housekeeping thing is we are going to have a networking at the end. So please do stay on after the panel. We'll go into breakout rooms and just kind of say hello, introduce ourselves to each other and just kind of have a quick hello. I do find that NYPAY is a phenomenal group of people and always get a lot out of the slight networkings we do now that we're not in person. There will be time for questions and answers from the audience. You can, we can, pop on at that point when we're not too big of a group. We can pop on and just ask them, give you the screen and you can ask them, or if you'd like to be anonymous or whatever, feel free to put them into the chat. You're welcome to chat them to me or to everybody and I'll monitor the chat. And without that, I will turn it over to Leslie and Sarah, and we'll go from there. Is there everybody good with all that? Did I remember all the housekeeping things? So we're all going to mute our phones and our cameras.
I think you
And-
did a phenomenal job there, Betsy.
Okay, very good. Thank you all very much. I really hope everybody enjoys this. I'm so glad to see the new people. Welcome, welcome to NYPAY. And we'll go from here. Off to Leslie. Thank you so much.
Thanks everyone for coming. I'm actually gonna kick it over to Sarah to start us off.
All right, that works for me. And you know, if the Zoom gods are with me, I am going to attempt to share my screen here. Hopefully that's working. So my job here is to just sort of give a foundational understanding of on-demand earned wage access. And while the product has actually been around for several years now, some of you may have just heard about it recently because it's experienced really some tremendous growth. And quite frankly, we believe now that it's being used by millions of US employees. So the description that I have here and displayed on the slide is really sort of an overview, a universal description, if you will, that came from a report that I published on the industry. And it's really not specific to any one market provider. And as we move along in this discussion, you know, our panel speakers will share more about their unique product and really how they differentiate themselves in the marketplace. I think from a starting point, it's important to understand that earned wage access is an employer-based benefit. So what I mean by that is it's offered like other work-based benefits. So you can think of it as something akin to, you know, paid vacation time. And it's also important to note, you know, what earned wage access isn't. And it's not a pay advance product. So pay advance is different in part because the worker in that relationship is outside of their relationship with their employer, is reaching out to a third party for an advance on their anticipated pay. So those are some important key features, I think, to keep in mind. Really, you know, employers who are interested in offering earned wage access will engage with a third-party provider, you know, like the firms represented here, and those providers will really orchestrate the entire process for the employers. And when an earned wage access program is launched, employees are instructed to download sort of the supporting app. Right. And after an employee has worked a shift or a day or some other defined interval, they're going to receive a mobile alert through that app telling them how much pay they have just earned and how much pay they can now access, even if their normal payday isn't until several days or even weeks away. So the employee, having gotten that information, is going to respond to that app and request how much of that available amount they want to have access to. And when the employee requests the funds, they're often received instantly, or instant funding is actually a part of the options available to them. And there are also options available to where those funds are deposited. They could go to an existing bank account, to maybe a payroll card, or perhaps to an account that's provided as a part of the service. And then that pay that is provided into that account is actually funded by the earned wage access provider. And I think that's an important distinction to understand as well. It's pretty rare that the employer themselves would be funding these. Not all businesses actually have, you know, the cash sitting around to be able to fund on-demand pay. It's when that regular payday cycle happens, that's when the employer and the earned wage access solution provider will sort of settle up, and the employee is going to receive the rest of their pay. So let me flip here to the next slide. There we go. So, really what's driving the growth of earned wage access? First, I guess the first one's really rather obvious, the near ubiquitous ownership of smartphones. But it's really critical to making this work so that, the amount that is available to workers can easily be communicated, and that provides the channel where the workers can communicate back to the earned wage processor. And what's interesting too is that some of the providers are also providing additional functionality through that app, like budgeting tools and helping workers to meet savings goals. Another instigator that's generating the growth of earned wage access is really the growth we're seeing in freelancing, or the gig economy, as we like to call it. Many gig workers are paid by the job, not necessarily by a calendar date, right? So, for example, if I get a job on TaskRabbit, I do some errands for somebody, and when that task is completed, I'm getting paid right away. So salary workers and hourly workers who might themselves also have a gig side hustle, if you will, they're kind of asking, why can't they be paid on a more frequent basis for their other job as well? And we find now that employers really view earned wage access as a means to differentiate themselves in the market when they're looking to acquire and retain good employees. I think this is particularly important now in this really difficult labor market like we've been experiencing, in part driven by the pandemic. And this employee perk can also increase employee retention rates and really save large employers at least thousands, even millions of dollars in expenses that they go through for onboarding and training costs and alike. And of course, the employees themselves are benefiting from having greater flexibility over their pay, which can lead to less financial stress. And that means, better, more focused employees at work. So the last slide here, I just want to talk a little bit about really that addressable market for earned wage access. And, it's kind of interesting to think about sort of the concept of getting paid, and you start to question, why is it that most employees are actually paid twice a month or every 2 weeks? And it actually seems that it's a bit arbitrary. But it actually has a lot to do with a precedent set back in the pre-computer days to give employers time to collect and process pay data and taxes. And it's also about managing the employer's cash flow. And it really doesn't have anything to do much with getting workers paid when they have completed their work or really when they have a need. And, those individuals who can truly benefit from having access to pay when they need it. It's not solely a function of how much money they make, although that's certainly an indicator. Really what's critical to understand is the population of individuals that are really on that, if you will, that thin line between being able to meet their obligations and really falling behind. Where that one unexpected bill or, maybe a drop in pay can really get them behind. And getting behind is where individuals find themselves paying overdraft fees and late fees from their billers and other expenses that get them, more and more behind and create greater and greater indebtedness. And we look here at some of the data from the Bureau of Labor Statistics. We find that the number of workers who are in sort of that fragile situation where they struggle to pay their current bills, or that one unexpected expense could put them behind is really kind of what I think is an astounding 28% of the workforce. So we're talking about tens of millions of individuals. And again, those who struggle to pay bills really aren't necessarily all low income earners. There are certainly those in that middle class who struggle as well. And quite frankly, I believe that the long-term flexibility and pay cycles will begin to become an employee benefit that's offered, much more broadly and may someday actually become the norm. So that's kind of my overview of the marketplace. And I think I'm going to turn this back over to Leslie.
Thanks, Sarah. That was a great overview. So hi, everyone. My name is Leslie Parrish. I'm a strategic advisor at Aite-Novarica Group, and I'm going to be moderating the panel today. So I'd like to introduce our three panelists, all of whom are executives at companies that are offering earned wage access or EWAs. So we have Matt Pierce, the founder and CEO of Immediate, Stewart Stockdale, the co-founder and CEO of Rellevate, and Matt Kopko, who heads up public policy at DailyPay. So welcome to all three of you. As Sarah mentioned in her market overview, this is a really fast-growing market. There are several providers that have come on the scene just in the last several years. So to start us off, I'd really just like to go one by one and have you all introduce yourself, kind of talk about what drew you into this market and how your company differentiates itself from other EWA providers. So kind of what makes your approach unique. So if you could spend maybe just a few minutes each talking about that. Matt Pierce, let's have you go first.
Yeah, Sarah, what a wonderful intro. Thanks for putting that together. Super insightful. And thank you guys all for taking some time with us this evening. Really excited to be here. So as I said, I'm Matt Pierce, founder and CEO of Immediate. Really quick background on us. We actually spun this business out of another business where we just saw a bigger need. We actually had started in 2016 as a home health and home care scheduling platform. And as we grew that business over about 2 years, we started seeing more and more that the issues with the post-acute setting and healthcare was not about scheduling. It was not about caregiver transparency. It was about the high turnover rates. And so we started this as a way to help companies recruit and retain talent. And we do this at no cost to the employer and a nominal transaction fee to the employee. And what we found is, as we've grown and scaled the business over the past few years, what we found was, and kind of the way we like to position is to say that we're a responsible alternative to the predatory lending offerings that are out there, be it running up credit card debt, writing bad checks, overdrafting accounts, or the worst situations, title and payday lenders. And so we really come at this from a responsibility perspective and trying to give people a safety net, a financial safety net for when they find themselves in a pinch in between paydays. So I'm excited to share a little bit more here over the course of the next 45 minutes or so, but thanks for having us.
Thanks. Stewart, why don't we have you go next?
Thank you, Leslie, and I want to thank New York Pay to having us present. I've been on here before with Western Union talking about the underserved with Ron back a number of years ago. So I myself have been in the payments business for a while. I see Mike Knowles, John Donovan, Ron, and Nabil, who I've either worked with or for. So it's been a process, and I think it's, I worked at MasterCard, I worked at Simon, where we did a big gift card program, Western Union, and JG Wentworth, and it was clear to me in the last few years that a lot of those folks are really not doing it justice for the underserved. And a lot of people give it lip service, just like CRM in its day, but nobody really did much about it. So we decided to tackle a pretty big chunk of the equation. So our process is a little more than just earned wage access. In fact, we see that as a hook product, but not a primary product, because I think there's life beyond earned wage access. But what we offer is a digital account. So think of a typical bank account. We don't charge anything for it. We give interest. We don't believe that you need a savings account, a checking account. Most people, they should just get interest on whatever they have in the bank. We insure every account to $250,000. They get a Visa debit card that they could use anywhere. It's not a payroll card or anything like that. It's traditional Visa debit card. We offer Pay Any Day, which is our earned wage access piece, where people could take earned wage, every day. They work today, they get their money tonight. We offer bill pay and what we call expedited bill pay. Nabil's on the call, and he knows that our best product at Western Union was Speed Pay, which was being able to pay bills real time. Because when the tax collector or somebody says you need to pay now, they don't mean 2 days from now via ACH, that they mean now. So we offer that. Send money, same thing, next day in real time. ATM access anywhere. And we're launching this quarter cross-border money transfer. A lot of our population are immigrants and migrants, and so they want to send money to other places. And everybody that serves this world completely overcharges. The banks overcharge, the payday lenders overcharge, the check cashers overcharge, the pawn shops overcharge, the money transfer providers overcharge, the bill payers overcharge. So everybody overcharges this population, but not by a little bit, but by huge margins. So when we go out, talk to employers, we offer all of these services to their employees. They sometimes ask us, how do we make money? Because we don't charge a lot, but we do, it's a clicking business. We charge a little bit, but we've got a whole holistic view on a number of different products. And it's the first time that consumer financial services are offered to employees as a benefit. They've got credit unions and banks that are kind of outside of the walls. But in our case, we're going into the employer, signing up the employer because we need time and attendance and certain things from the employer. But that's our solution. And we've been at it for, a little over a year, and, things are going great.
Thanks, Stewart. Matt Kopko, can you tell us a bit about yourself and DailyPay?
Sure. Yeah. Thanks, Leslie, and glad to be here and glad to be alongside other great panelists and be at this great event. So I'm Matt Kopko. I'm the head of policy, vice president of policy at DailyPay. We're the largest EWA platform in the country with millions of employees eligible on the platform. And just briefly about me, I've been in the public policy role for a few years. I had a stint before this working in the scooter wars for a scooter company called Bird. So I'm used to emerging technology and the way it impacts state types of regulations and statutory systems. And before that, I was a practicing attorney and a federal regulator. But been excited to be here at DailyPay and see tremendous growth of this industry over the last few years. I was not the founder of the company, but our founding team was New York-based financial engineers, and around 2015 started out on this mission. The reason for the company being started was because the founding team started looking at how long it is between people performing work and getting paid, and it wasn't just in the employment context where you can get a delay of multiple weeks and you're in effect loaning your employer your wages. In certain gig contexts, it also wasn't the way it is today, where people were being paid immediately. Delivery drivers, delivery workers, everyone was experiencing this multi-week lag between work being performed and being paid for that work. And we thought, well, there's a really great business opportunity here to shrink that time period because people are increasingly relying on instant technology. They presume it kind of as a matter of fact in the 21st century. And the idea that you're paid just once or twice a month or have to wait weeks after you perform work to receive your pay is something that's increasingly antiquated. I think people, when you think about a world of instant everything, that's kind of a big relic of the past that hasn't been innovated on recently. And so for me, it's been really gratifying to be part of the DailyPay revolution. For me personally, helping protect good paying jobs with benefits against that draw of the immediacy and the simplicity of gig work is very important. So we find that our service helps people stay in jobs that have benefits and have good paying wages rather than having to go towards things like gig work, because this concept of immediacy is really important to people. As we say, life doesn't wait for the 15th or the 30th of the month. And in terms of DailyPay's differentiation, we believe that we provide a comprehensive financial wellness platform for employees. We provide a seamless experience and additional HR tools for employers. So there's kind of a two-sided market benefit there. And we have great savings tools for our employees that we'll talk about, I think, a bit later in terms of our other offerings. And I just have to put one plug in here too. We have our pay balance, which is this patented algorithm that gives employees up to the hour updates in their phone on what their net take-home pay accumulated to date is. And Time Magazine actually called that one of the greatest inventions of 2021, because most people's experience with their pay is an amount appears every 2 weeks or even less frequently in their checking account, and they don't know how it got there. And now we have an ability where people can interact with and watch their pay balance grow on an hourly basis as they're working live. And so this is a great informational tool for people to help them be better budgeters, and just excited to be part of this great industry and help talk about these issues and how earned wage access and fintech is doing away with things of the past like the payday cycle and payday loans.
Great, thanks. Thanks to all of you for that. I want to get started with some of my questions to the panel, and please feel free to pop any questions that may occur to you in the chat. I see we have a couple already, which is great. But I want to talk about the extent to which employers are interested in offering this kind of benefit, and maybe how the pandemic has affected this, if there have been any changes in the last couple of years. And also the changing expectations in how pay is delivered among employees. We've touched on that just a little bit, but maybe we can dig into that a little bit more. So Stewart, maybe we can start with you for this one. Have you seen employers' interest change during the pandemic and the resulting labor shortages that we're seeing now? How has that kind of evolved over the last couple of years? Oh, and you're on mute, actually.
When we started building Rellevate, which is 3 years ago, we were in a really tight labor market. Remember the what we call the good old days? We had 3.5% unemployment, and everybody, it was all a fight for employees and quality employees. Very different than today. At the time, people were still working 2 to 3 jobs, and the average household income in this country was $45,000. So most people could not make a living or a decent living on those salaries, and that's the average household income in this country. But the pandemic is really, I think there's 2 things that have happened. One, people are more aware of of the category, right? So people know earned wage access. There's a number of players out there. They're all banging on people's doors. There's more news about it. So it's not a complete novelty to the employer when somebody comes and knocks on their door. Number 2, the receptivity has changed for obvious reasons, right? So now it's about retention and attracting people. And I think it's, if anything, we've learned that it's now the day of the worker. I mean, I have big employers who told me flat out, we really never focused on the hourly employee. How scary is that? We would just hire them, churn them and burn them and replace them, even though it cost them about $2,000 to replace one of their employees, but it wasn't really a big focus. Now that people can't find employees, and I think the tide is turning to employee more demand to Matt saying it's easy to say Matt because there's 2 of them. It really has changed the paradigm, because I think the gig economy has really changed some of that, but I think that's even going to change with employees, even at fast food restaurants, because they're going to dictate more of their terms. So I think it's going to be more on a menu based on the employee demanding stuff rather than the employer having full control. So I think that pendulum is swinging somewhat. So I think the receptivity is there. I think you still get some HR departments and payroll departments feeling that they're overwhelmed because of all of the disruption going on in the marketplace. So timing and how invasive is this implementation, which isn't very invasive at all, but they perceive that you're not going to find payroll departments that are really at the front of innovation, because I'm not from that industry, but I've learned a lot. They feel overwhelmed and underappreciated and certainly understaffed. And with everything that they've got going on, they've got a lot on their plates right now. So I think that the receptivity is there. The one caution ends up being is, could they implement right now? But if you get to the right person at the company, i.e. a C-level, then it becomes a lot easier sell, because they see that the desperate need of their employees and the business rationale. So I think that the pandemic has actually helped accelerate the category big time.
Great. And just moving over from the employer perspective to maybe the employee perspective, Matt Kopko, I'm wondering if you could share with us, who's using these types of products? What is there, like a typical profile of worker that you see most often? How would you describe them?
Sure. And I'd say we agree with what Stewart said in terms of the general trends we're seeing in the marketplace, in terms of COVID being an accelerant towards the need to have even more financial flexibility. In terms of the actual employees on the platform who rely on the service, we see them delineated typically in the lower to middle income brackets, concentrated in particular industries that are focused on hourly, retail, grocery, hospitality, a lot more that we can get into detail on the types of industries, a lot of healthcare, actually, nurses and home care providers. And then in terms of demographics, we did some research on this and found it very informative, because we found some developments that you might not have normally guessed. The average EWA user from certain research we did is more likely to be female than male, is one interesting result that we found. Is more likely to be younger, majority are under the age of 40. And is also more likely to be non-white than the average population. So there are a couple key factors that are interesting in terms of, it tends to be people who have a need for financial flexibility and financial alternatives that are not punitive or predatory. And the demographics seem to kind of back up that type of profile.
Great. And Matt Pierce, love to have you respond to anything Stewart or Matt, the other Matt, have said. I saw you nodding your head a little bit there, but also just wanted to ask you, do you see changing expectations on the part of workers? Will we all kind of want this on-demand pay option, and will we kind of evolve to that point over time?
Absolutely. And to tack on to the earlier comments, we see very similar results and within our user community. About 83% of our users earn less than $30 an hour, so less than $60,000 a year, and I think the number is 78% of our users are female. So about 4 in 5 are female. So we're seeing similar results in usage rates as DailyPay. When you look at where this market is headed, I truly believe that by the end of this decade, every company in the U.S. will be offering some form of earned wage access or on-demand pay. And a lot of it is driven through what we've been talking about, right? It's the rise of the gig economy. It's people expecting to be able to work and clock out and get paid. And when you go and sit down in some of the similar conversations that Stewart's having, when you sit down with HR professionals who aren't really thinking about that, or it hasn't crossed their plate, and probably similar to both of them, we still have conversations every week where people say, how's it 2022? And I've never heard of this before. And I think that that's going away. We're having that comment pop up less and less often. But I do believe that as we continue to evolve as a society and specifically around finances and people recognizing the need for accessing your money before payday, over the course of the next few years, I think this is something that will not only be expected, but will be utilized across the board. We have I've actually had our team pull the figures from Q4. Our lowest paid employee, our lowest paid user in Q4 made $8 an hour, and the highest paid made $75 an hour, $150,000 a year, right? So everything in between. And I shared the other figures earlier where it's heavily weighted towards under $60,000. But when you think about the fact that there's people that are making 6 figures that are using this, it's in some cases, it may be because they're living paycheck to paycheck. In other cases, it may simply be because it's their money, right? Once it's been earned, it's theirs, and it's just sitting in a pay cycle waiting to be paid out next Friday. And so I do believe that as we continue to evolve and recognize the need and on-demand pay over the course of the next few years, this has become table stakes for most employers.
Great, thank you. Now, the title of this session alludes to the fact that EWA could serve as an alternative to high-cost credit like payday loans or other strategies that you all have mentioned that could be arguably inferior, credit card late fees, overdrafting a bank account. And so I guess my next set of questions is going to center around, is this really going to be a substitute for more expensive alternatives, or are workers just using this alongside payday loans? So is it going to just kind of be layered on to these strategies? And I think that's kind of an important policy question of where we go from here. So Matt Pierce, I'll start with you again, if you don't mind. But I want to get your thoughts. And, is EWA supplanting payday lending, or does it have the potential to eventually as there's more and more adoption?
100% it is. It's when you look across the US, the national average APR for a payday loan is 391%. You take states where we've got one of our largest customers like Texas, where it's 664%, or we're headquartered in Birmingham, it's 456% APR here. There's only a handful of states who have made payday lending illegal. And in those states, in a lot of cases, you've seen title loans kind of shoot up, right? And so while the national average APR is 391%, on average, payback on a payday loan is about 36%. So if you take a $250 payday loan, when it's paid back, it'll cost $90 in fees. I don't know the exact numbers of what the other guys here, what their organizations are charging, but for us, we charge a flat rate of $3 per transaction if you're moving money into your bank account or onto a loadable Visa or MasterCard, a bank issued debit card. And then we offer free transactions into our own card. And so when you look at that, if I pulled out $250 using a payday loan, it's going to cost me $90 in fees. If it costs me $3 to use immediate pay for that same $250, then obviously there's an $87 difference. And so I do believe that by putting things like this out there, it is providing people with an alternative. In a perfect world, those payday lenders start to really change their tune and start to change rates, but it's not a perfect world. And we know that right now, the way that we're doing this and the way that all three of us, as far as I'm aware, are all delivered through businesses, right? So you have to be employed in order to leverage one of our platforms. And so I think when you look at that, there's still a large number of people that are unemployed, or people that, quite frankly, their companies today are not yet offering something like this. They're still turning to those predatory services. But what we're trying to do, in a lot of cases, when we talk to companies, we talk to them about joining us in the fight to eliminate predatory lending services, and we have to partner with them in order to do that.
Absolutely. So Matt Kopko, I want to turn things over to you, because I know you and actually we partnered with you on a survey asking some of these very questions. So I wonder if you could share some of your findings.
Yeah, sure. Well, as the resident policy wonk on the panel, I'll try not to get too wonky, but these are topics that are, I live in and die for. So they're fantastic topics to talk about. And so to be on a panel where we can talk about substitution effects and surplus capture and surplus return just gets my juices flowing. So I'll apologize for my excitement, but it's a great question. It's probably the most fundamental and important question facing this industry is, is this something that is just an additional thing that people do, or is it something that can actually supplant other much worse financial behavior? And we look directly into this, in terms of stats. We have other stats from the Pew Group and others that say it's actually much worse than that $90. The average payday loan is turned over about 8 times and can rack up a bit over $500 in fees and interest under the kind of normal rollover environment, because payday loans tend to be encouraged to and are built to be rolled over and over again. So it can be very dangerous to be sucked into that cycle of debt. So to get to the bottom of whether or not this can be a solution to that is fundamental, I think, to the consumer good that's created here and to the future of this industry. So we took it as a personal mission to get to the bottom of this and did in-depth research that we worked on to look at these questions, and Leslie collaborated with us on this. So some of the findings were very interesting in terms of prior to access to our earned wage access service, people were very heavily reliant on some of these pretty dangerous alternatives. And, for those of us who are more lucky and blessed in our life and careers, who aren't regularly interfacing with payday lenders or having to reconcile with overdraft fees and things like that, it was really a wake-up call to see how pervasive this problem is, especially when you think about that the average profile of the worker here is typically an hourly worker, moderate or lower income. And so what we saw was about 1 in 5 of DailyPay users reported prior to being able to have access to DailyPay that they actually recently had relied on a payday loan. The general stat in the general public is about 5% of the public over the past 5 years. So we're talking about multiples of incidents of this product's capability and this product's prevalence in these types of populations. Similarly, with overdraft fees, it was almost 4 in 10 or 2 out of 5 said that they've recently overdrafted, and about a full half of those, so another 1 in 5, were saying that they were doing it either once a month or more than once a month overdrafting, and those are $35 a pop. And then we looked at their behavior after DailyPay, and what we saw was, I wouldn't call it perfect substitution, but comprehensive and about as perfect as you can get in an open system in terms of substitution. So from the payday lending perspective, about 4 in 5 of the users who were previously relying on payday loans said that they were able to essentially never have to use a payday loan again. And the remaining 20%, I think the data I have says about 3/4 of those report reduced payday loan usage. So, almost everyone was able to essentially cure the cycle of debt entirely. And those who weren't were able to actually at least, have some sort of reportable improvement in their financial condition. Similarly, with overdraft fees, again, an overwhelming majority of people who were previously relying on overdraft fees, especially those who were relying them on a regular basis, were able to report they either had to rarely or never overdraft again. So we're talking about, if you're just overdrafting twice a month, that's $70 a month, almost $1,000 a year that you're paying just in overdraft fees. Your average payday loan is $500. If we can, from the rough math I've done, I would say that we've eliminated about 80% of that harm from the system. And then the remaining 20% is about 10% of surplus to the provider and 10% of surplus to the consumer in terms of the ultimate cost. So you're probably reducing the cost by an order of magnitude or taking a 0 off the end. And the provider is maybe taking a small part of that. So from the research we saw, and I'm sorry if I already went back on my word in terms of being too wonky at this point, but from the research we saw, substantial substitution across the board away from these services towards earned wage access. And what Matt laid out earlier in terms of the math behind it, it's very obvious to the users of the system, right? It's I can pay hundreds of dollars or $35 to do this one thing, or I can pay $2, $3, or $0 to access my own money and not have to go into debt in the first place. And that proposition is very compelling to people, especially those in the lower income bracket who are really susceptible to these types of very expensive alternative services.
Thanks. Stewart, I'd love to get your thoughts on this as well. What are you seeing in terms of the potential to disrupt payday lending or other kind of high cost strategies with earned wage access?
We see it a little broader than just payday lending and check cashers per se. The way we look at it is consumers have buckets, and everybody on this call has a lot of buckets to go access cash. It could be a credit card bucket, it could be a savings bucket, it could be a 401k, it could be, on and on and on and on. And some are big buckets and some are smaller buckets and some are big expenses. It could be a college loan or college tuition and so forth. That isn't really people that are underserved. That's just people that need money. You pay $35,000 per semester, that's cash flow. And so we look at it as cash flow, and everybody has cash flow needs. Everybody on this call has cash flow needs, but people have different buckets. The most obvious one is the payday lender, because they charge, I think the quote was 300%, 400%, whatever it ends up being, but it's onerous. We have a lot of customers that are converted from paying with checks. Those people would go to the check casher and pay 7 to 9% to cash a check. I mean, and a lot of people, believe it or not, in today's day and age, still pay with checks. But 7 or 9%. So if the check's $1,000, you're paying, $80, $90 to cash a check. Somebody mentioned overdraft fees. Happens a lot. Why do banks charge over, $35 for an overdraft fee? Because they can, right? And if you complain, they say, well, don't overdraft. It's pretty simple from their perspective. A bank account, typical bank account in this country is $15 unless you have $3,000 minimum. You multiply that times 12, that's a big number, right? Why do people charge $15 for a bank account? Because they can. Credit cards. Everybody here has credit cards. Everybody here every once in a while doesn't pay on time, and you're paying 18, 19%. The cost of funds for the last 5 years has been minuscule, and the credit behavior has actually been pretty good. But the banks have stayed at 19%, dating back to when Mike Knowles was on the call and I worked at Citibank, and rates were 19%. The last time that Jimmy Carter raised interest that high, they raised them and kept them. Why? Because they can, and they make a lot of money. Money transfer, money transfer, 7 to 9% of the cost of the principal of the transaction. Why? Because some people have certain quarters that they could dominate. So what we're trying to do is democratize it a little bit, give people options. For people that take our product, we get about 20 to 25 transactions per month, of which, on average, 2 or 3 are pay any day. Which we love. People are getting access to cash. They're replacing that. They're not doing overdrafts. They're not doing certain products, certain behaviors, but they're replacing a whole bunch of onerous channels or onerous products with our product. And if we could force other industries to lower prices, and obviously the earned wage access is one that's happening, but the challenger banks are doing their thing and lowering cost and lowering monthly fees and so forth. So we look at it, payday lending. Yes, they should be put out of business, or at least put a big dent. But let's be honest, they've served a need for the last 20 years. They're there because people need them. It's not because they're necessarily bad people. They charge really high rates, but they've provided a service for a long time that people have needed. And shame on the industry for not having offered better solutions. And I think finally now these solutions, technology is allowing us to offer these better technology. And that's why we jumped into the game with kind of a startup to, which is a pretty ambitious proposition, given all of the channels that we're going after and the competitors. We're not just competing against the DailyPays and Matt's company. We're competing with a whole bunch of others as an integrated solution. But it is about offering a better product to this population, but not just the needy. There's people that make $200,000 that have cash flow needs, and they might as well use their pay rather than a credit card. I think it's going to take some time to educate those people. The obvious ones are the low income ones, but everybody has cash flow needs in our perspective.
Absolutely. Well, we have about 15 minutes left before people break out for networking. So, and we definitely have a lot of questions in the chat. So I want to both encourage folks to keep putting questions in the chat, but also get to some of these questions now. So one of the first questions, I think this is pretty foundational, is, who pays for this? What's the revenue model here to actually bring these EWA programs to life? It sounds like the employers typically don't pay. So how does this all work? So you all can keep your lights on.
Or I'll start with that. So there's a kind of a current business model. I think there's also some thoughts on the way the industry is evolving. So right now, the way DailyPay's pricing works is for our typical employer contract, what we'll offer employees is two choices. The ability, kind of like Venmo, the ability to get it right now through an instant payment rails, or the ability to use the legacy ACH system. What we typically charge is a fee of about $2.99, a nominal processing fee for that instant transaction. And increasingly, we're offering that next day ACH option, just like Venmo, for free. It's actually faster than Venmo. Venmo is 3 to 5 days, and we're 24 business hours. So there's a kind of a free version, and then there's an expediter or upcharge fee if you want to get funds within a few minutes. Increasingly, what we're also seeing is, and I think some of the other market participants, I'd be curious to see their thoughts as well, is there are a lot of other parties, banks, other financial institutions, merchants, and other providers in the financial ecosystem who are interested in having some sort of either commercial relationship or product or goods service or transaction with these workers. And so being able to have a strong relationship with them at the point when they're earning money brings in a whole host of other parties that are willing to either subsidize those fees, pay part of those fees, or potentially provide an opportunity to have free transactions so that, for example, the user is buying products or goods and services at their place of business. So we see that increasingly happen. It's still typically the transactions fees that are kind of the core of the revenue model right now, but we're seeing in 2022 and beyond a lot more activity in this kind of ancillary space where other people who are involved and interested in interacting with consumers at the point where they're earning money want to potentially take some of that fee burden in exchange for an opportunity to transact with the worker.
Matt Pierce or Stewart, either of you want to also tackle that?
Yeah, Stewart, I'll jump in real briefly. We're very similar pricing model for them to move money into a bank account or a bank issued debit card. We launched in Q4 a gift card option. So we found just in surveying our users that a lot of people were using this specifically to pay bills, and so we've gone out and formed partnerships where we can actually, in some cases, they can have bonus money. So they need $100 to pay a bill. They go in and pull out $90 from their paycheck, and then they get a 10% bonus, so they can go pay their bill on time. And what we do is we actually we fund those users' accounts, and then we're reimbursed as part of the standard payroll cycle as a deduction on their next paycheck. And we also give the employer the ability. You mentioned earlier. You said it sounds like most employees are paying. Most employees do pay. We do give the employers the ability to fund those, and we have some specifically in senior living and in hospitality that will step in if they're having trouble filling a shift on a weekend. They may step in and say, "Hey, anybody who works on Saturday, we're going to pay the immediate fee in order to transfer their money at the end of their shift." And so we do have employers that step up and do that. But by and large, it is paid by the employee. So if somebody requested $100 into their under their bank issued Visa card, would send them 97, and then we deduct from their next paycheck $100.
And I'll just add that ours is similar for that. We don't charge any. We charge $295 for the what we call Payday Day that goes directly into your Rellevate account. And it's going into an account that we, in essence, manage and control. We don't charge anything for the debit card. We don't charge anything for the monthly account. They get to use that, obviously, free of charge. Bill pay for the expedited version, we charge $295. For the ACH version, it's free, like any bank. Send money, you can send money person to person for next day for free. If you want to send it directly to another person's account real time, like right now. And it's not like Venmo, which is, circulating in a system, but it's going directly into somebody's bank account. We charge $295. Obviously, they could use their ATMs anywhere. We give some free. And then we will be announcing our cross-border money transfer fees soon, which will be significantly lower than the traditional remittance players. But it's all funded by the employee. We have a couple employers that subsidize and do that on behalf because they want to do it, but we don't ask for it. We just offer it if they want to do it.
Great. And one other, I guess, foundational question that I'm seeing here. I know some of you mentioned the employer isn't actually having to take funds early and give their employee access to wages during the pay period. So who's funding the EWA payout ability? Is it a bank that's approving short-term loans? Is it your companies directly? How does that funding mechanism work?
We all have warehouse lines that fund that. I assume that DailyPay and Matt as well. But so yeah, these fintechs fund it 100%. The employer, in essence, other than soft dollars, they don't pay anything, and they get the benefit of the float.
Yeah, I mean, the way DailyPay works is we maintain a network of capital markets partners. We're venture funded on the equity side. We also have various debt arrangements and other capital markets capabilities that we've built over the years with our financial partners. So same business model that Stewart's talking about in terms of, for these systems to grow in the speed they have, telling an employer that they have to start changing their payroll funding or overhaul their payroll systems is typically just a non-starter. So we had to build this layer in where we can handle that capability on our own. And one of DailyPay's important focuses is to be the best capitalized player in the space, because when you operate this service for very large employers, obviously there are large solvency and creditworthiness needs that the employers want to see to make sure that you'll be able to effectively handle the system for their employees. So we've built up a pretty formidable capital markets team that is out in the markets with a variety of different products and services on the back end, on the institutional side, to make sure that we have the necessary resources to keep these transactions going.
And same here at Immediate, but just a grouping of financial institution partners behind the scenes that allows us to fund that float and then get reimbursed. One of the things that we've found from financial institutions is they like this because the turnover is so much more quick, right? If you're a large bank and you're going out and you're lending a commercial real estate company millions of dollars to go build a new community, it's gonna take you a year, 2 years, 3 years to get reimbursed on that. Our average outstanding is about 10 days. So they're getting reimbursed every 10 days and just continually making those transactions.
And the only comment I would add is that you're really, the biggest risk ends up being the employer. Not the employer, you're going to have some fraud, you're going to have some people leaving and that sort of stuff here and there that you're not going to catch. But it's really the employee. If the employer goes away, there's a lot of protections for bankruptcies and making payroll and that sort of stuff. But if you sign up a small person that may not be there, 2 weeks from now, then you may have a problem. But those are few and far between.
Seeing a few questions here coming in, both earlier and then just now, to think about how this evolves if cost of funds increases, so interest rates go up. How does that impact your businesses? Other kind of market changes, such as more real-time payments and that becoming the norm. How does that kind of change your business models, if at all, or how does it impact your business models?
I'll jump in first. So for real-time payments, to us, it's just another payment rail, right? We can still deliver. I don't necessarily, real-time payments is going to change the way people are getting paid from an on-demand or earned wage access perspective. As interest rates climb, we talk about that as well. There's just because of where we are and because of the scale with the organization that we have and the financial capital partners behind the scenes. And because of the short amount of time that we're floating these small dollar transactions, interest rates aren't a major impact to what we're doing as an organization. So also think that, as you look at inflation over the past 18 months or so, what we're seeing is, inflation at say 8%. When you take out taxes, people's incomes have not risen by 10 to 11%. And so we are seeing people that are coming in and using this more and more frequently. And so you tack in interest rates and some of the things that come along with that, on the back end, it doesn't have a huge impact to our business across the board.
Yeah, it generally impacts our cost of funds when we're out in the markets for the financial infrastructure. And then in terms of RTP, totally agree with Matt. DailyPay actually announced a partnership with PNC Bank and the Clearinghouse last year. So we're actually providing, in certain circumstances, earned wage access through the RTP rails. So it's a nice additional choice. You have to build capabilities with a lot of the different financial infrastructure providers here. So we wanted to be an early adopter of RTP and excited to see that grow.
Yeah, I mean, we already pay people real time on everything that we do and have that capability. So I think do the math, right? The average duration here is going to be, mostly, 10, 11 days. I mean, if it's a 2-week pay cycle, there's some cases that are a month pay cycle, but assume on average 2 weeks, many are 1 week. And you've got a $200 outstanding for 3-4 days. The cost of funds, even if the cost of funds doubles or triples what it is today, it'll still be under $1. So it's not a huge part. I think that what people are charging at $295 more than covers that, including risk. I mean, you got to leave margin there, but and again, that's not our only product from our perspective. So that we always debate on which product should we incent more versus others, because we don't just rely on it primarily. Do we give one for free or the other one not for free? What we want is overall usage. So it's a big focus for the economy in general and for the cost of funds to Matt's point. But it's not a huge issue on pricing.
We have a few minutes left, and please put any questions you have into the chat. I'm really happy to see all these questions coming through and the level of engagement. But one question we have is, maybe if you all could look out, in your crystal balls, maybe 3 to 5 years or so. Do you see banks becoming involved with this, or maybe other players even disintermediating this market? I'm thinking maybe payroll providers themselves. What do you see in terms of other players getting more involved in this space? Any comments on that?
I'll give you my 2 cents worth first. I don't think the big guys, the payroll guys and the other, even if they do it, which they probably will, are they fast and nimble is the question, right? And are the banks fast and nimble? Most likely, if they love the category, they'll buy one of the players like they've always done, right? They'll jump in and they'll buy, whoever they like in the category. But clearly what's in the next 5 years from now, earned wage access will be top of mind. And the whole concept of getting paid every 2 weeks will be hopefully a distant memory of why did we ever even pay every 2 weeks, or at least not have access to it. So, and right now there's a big gold rush because everybody's running for relationships, right? All the people on this call are trying to sign up as many employers as we can, because that's the land grab right now. And you've got contracts, and once you have the contract, that employer isn't going to offer the other competitor until they drop out the system. And to yank you out of the system is something that they need to think about. Unless you really are negligent and don't offer good service, they're probably going to stick with you. So right now there's a mad race for gold. And 5 years from now, that'll be divvied up. There'll always be rotation and share shift. But right now it's the Wild West.
I agree with Stewart. It's a land grab market. There's as Sarah shared at the beginning, there is a huge potential here, and we're still in the really early stages of this market. And so when you kind of fast forward out over the course of next couple of years, continuing to grow at a rapid pace is most important. And to Stewart's point, we're around 200 customers, employers around the country, and we've had zero attrition since launching our first customer in September 2019. One, I think it's because we're doing a great job in supporting those employees and those employers, but also too because it isn't a real, there's some lift that goes into going in and plugging this in and rolling this out, and so long as you continue to provide great value and great service, you're going to be in it for the long haul.
I know we're at time. I'll just say briefly, we see a lot of interest and focus from other financial institutions and payroll providers and payroll ecosystem providers in getting involved in this space. A lot of the banking world, including like the neobanks, love advertising 2-day early pay in practice, it tends to be often 1 day early pay. So, we love to show up at the conversation and say, well, what about those other 14 days of the month? And we have exciting partnerships that we've created with payroll providers, some of the leading payroll providers, including ADP. And I think you're going to see more in this space, not just out of DailyPay, but out of the industry in the coming months and year or two, because there's a lot of interest from the legacy financial ecosystem to figure out, okay, well, how do we keep up with these reforms? Is overdraft reform going to be enough? Is this going to be an alternative to overdraft now that people can offer alongside? I think there'll be a lot of propagation of this type of technology throughout the financial ecosystem.
Great, thanks. Well, I just want to thank the panel again. I really appreciate all of your thoughts and just description of, what EWA looks like at each of your companies and where you think the market is headed. It's really exciting. And with that, I'll turn things back over to Betsy for kicking off networking.
Thank you all very much. This was a really interesting topic, and I appreciate everybody's engagement. And hopefully when we do the random groupings, if Matt and Stewart stay on, we can actually have some more conversations about this topic, because it looks like it's interesting. Just looking at the chat, everybody's got really good ideas going here. So I just want to thank everybody. This was really, really interesting. A really, really very good panel and great engagement. And so Leslie's got, okay, Leslie said something to me. Actually, Leslie, you sent that just to me, not to Sheila. You might want to send that to everybody. Anyway, so Nikki I appreciate it. However many of you would like to stay on with us, stay on. I personally find it is very, very helpful. I would say after every single one of my NYPAY networking group breakouts, I have had several one-on-one meetings. So it really is a really good group. Stewart's been with us so long, he can tell you what a good group it is. So Nikki is going to hit the random breakout groups. We will be in random groups. She may, hopefully it will work out that one of the NYPAY committee members is in each group. If it doesn't, just feel free to introduce yourselves. There was not a lot of structure here. Everybody kind of go around the room, introduce themselves, say hello, give a little bio or whatever you'd like to say. And then however the conversation flows, we're trying to simulate being in the legal offices we used to meet at, with standing around with our beer in our hand or a glass of wine and chips in the other hand and just chatting away. It's hard to do in these pandemic days, but on the other hand, we have people with us. I'm very interested in meeting Sheila. She's been chatting a lot here, and she's in California. So she wouldn't have been in the legal offices with us in New York chatting away. So anyway, so without that, anybody else want to say anything before Nikki hits breakouts? All right, everybody knows how this works, right?
I'm just going to make one suggestion, Betsy.
Yep.
And that is, if anybody wants to put their contact information into the chat area, and then you just save that to your notes, and you can call on people or reach out to people. It could be your LinkedIn contact, it could be email, however you'd like to do it.
Yeah, and it may look like you've lost the chat, but when we all come back, you get the chat again. All right. Very good. Oh, and Sheila's saying she's got to fly to she's going to fly to New York in a heartbeat. We'd love to meet you, Sheila.
We'd love to see you, Sheila.
Next time we do get to meet in the, who is it? The Dwight, our sponsors, give us a very nice space. Okay. So Nikki, go ahead and hit that. Everybody can turn back on their videos and audios now, if you'd like to. Go ahead, Nikki.
Okay.
Thank you so much.
You're welcome.